What you are looking at may be the biggest increase of any asset class in the last 100 years.
Our gold company is earning a lot of money right now. It could go a lot higher if we're actually repricing paper currency relative to real assets.
In August 2025, gold was trading at $3,300 an ounce. By October, prices rose to over $4,400 an ounce, a 32.5% rise in just 2 months. Is it that the price of gold is going up, or is it your dollars that are losing their value? Let's take a closer look. Imagine the house your parents bought in the 1970s for $60,000 that's worth $1 million today. It hasn't actually gone up in value. The chart shows how much gold you needed to buy a median house in the USA for each year from 1970 to today. In dollar terms, it looks like house prices have increased tenfold. But in reality, a house that cost 185 ounces of gold in 1970 costs 180 ounces of gold today, actually 5 ounces cheaper. Your house didn't suddenly become more valuable, it's your money that got weaker. The US dollar, the Indian rupee, every paper currency out there, they've all been silently losing value while we continue to celebrate the illusion of getting richer. Thousands of years ago, when trade first started, there was the barter system. If you liked something I had and wanted it, you had to provide me with something that I considered to be of equal value. On a broader scale, this wasn't possible, and so currency was created. Back then, currency used to be pure gold or silver. Its value was tied to something tangible. Enter medieval times. Rulers realized they could debase currency by mixing cheaper metals like copper or tin into gold or silver coins. This practice wasn't new. Notable early examples include Athens during the Peloponnesian War. The Roman Empire under Nero marked the beginning of large-scale debasement of the silver denarius. The imperial mint reduced the silver content and issued vast quantities of coins with a copper core and a thin silver wash. This steadily eroded public confidence in the currency. This was even seen in the Ptolemaic kingdom in Egypt and the Han dynasty of China. The precious metal or intrinsic value was reduced dramatically, in some cases by more than 90%, but the coins still circulated at the same face value. This allowed rulers to mint more coins without increasing real wealth, often leading to inflation and a loss of trust in the currency. It was an early lesson in how governments could manipulate money while keeping up the illusion of value. This is called debasement, a reduction in the value or purchasing power of money. Global debt is above $315 trillion, around 3 times the world GDP. Governments print and borrow beyond any increase in real productivity, steadily eroding the purchasing power of the currency you hold. As paper money is debased, gold, silver, and even Bitcoin become the measuring sticks that reveal it. When fiat currencies weaken through overprinting and debt, precious metals still hold purchasing power because their supply is finite and independent of government policy. Home prices may be surging in many parts of the world, but when measured in gold, much of those gains shrink or even disappear, especially after 2020. This isn't limited to developed nations. Let's take an example of a developing nation, India. In India, a 1,000 square foot home that cost 2.5 million rupees, approximately 3,500 tola of gold, in 2005 now costs 12.5 million rupees, but only 1,000 tola of gold in 2025. This means that a 1,000 square foot home is cheaper in 2025 in gold terms than it was in 2005. Gold prices have been climbing steadily, and this rise is driven by a series of fundamental shifts across global finance. It was bad, but not that bad, until the COVID pandemic in 2020. And then boom. How do you tell that your currency is being debased? The yield paradox. When governments need money, they borrow it from investors. One of the safest ways they do this is through government bonds, like US Treasuries. Here's how it works. Imagine you lend the US government $1,000. In return, they promise to pay you interest every year, say 5%, and give you your full $1,000 back after a set period. That annual interest is what's known as the yield. When yields rise, it means investors are demanding higher returns to lend their money. Usually, higher yields make bonds more attractive, like a bank offering better interest on your deposit. But right now, something unusual is happening. Yields on US Treasury bonds are at multi-year highs, yet investor demand remains weak. Investors aren't seeing high yields as attractive. If your currency is losing value, rising yields don't mean anything. Investors are now asking the tough question, where can my money truly hold its value? Even in advanced economies like the United Kingdom and France, rising bond yields haven't drawn investors back. Many large funds are instead demanding inflation-protected bonds, commodity exposure, or alternative investments like infrastructure and real assets. All of this reflects a deeper shift, a growing mistrust in governments' ability to keep their fiscal houses in order. And when that trust begins to erode, even high yields may not be enough to bring investors back to the table. Geopolitical risk. Before 2022, many central banks, especially in developing countries, held a large share of their reserves in US dollars and euros. These are highly liquid and widely accepted. The Ukraine war changed the game. After Russia's invasion of Ukraine, Western governments moved swiftly to freeze large parts of Russia's foreign reserve holdings. Some estimates place the total at around 280 to 300 billion US dollars. It made it impossible for Russia's central bank to trade or dispose of those reserves held in Western territories. That move sent a powerful signal to central banks around the world. Even sovereign reserves held in major currencies and global financial centers could be subject to geopolitical risk. One of the most prominent shifts was toward gold. In 2022, central banks added about 1,082 tons, their highest in decades. Over the last 3 years, central banks have consistently accumulated more than 1,000 tons annually, up from averages of 400 to 500 tons in earlier decades. The rush to alternatives. The de-dollarization trend is not limited to gold. Nations and investors alike are seeking alternatives, including digital currencies, commodities, and bilateral trade in local currencies. While no single replacement for the dollar exists yet, the collective diversification away from fiat dependence is unmistakable. Generations. How does this affect generations? When the value of money weakens over time, the debasement we spoke about, it doesn't affect everyone equally. Baby boomers hold 51% of all wealth despite being 20% of the population. Their houses, bought on average with 3 times their annual salary, now cost millennials 12 times their annual salary. Older generations, who already own real assets like property, often benefit when asset prices rise, but again, only in currency terms. Their wealth grows because the things they own become more valuable in an inflationary environment, again, because of the fall in currency value. Younger generations, on the other hand, hold much less in hard assets. Their wealth is mostly tied up in cash and wages, both of which lose value as prices climb faster than incomes. So while housing and assets appreciate, their purchasing power shrinks. This divide fuels younger investors to turn toward Bitcoin and decentralized finance as a response to perceived injustice in the fiat system. Policy crossroads. Rate cuts, shutdowns, and trade wars. The United States is approaching a familiar cycle. Government shutdown threats, widening deficits, and political paralysis. Simultaneously, Renewed trade tensions between the US and the world are reshaping global supply chains.
Starting tomorrow, the United States will implement reciprocal tariffs on other nations.
Protectionism tends to raise domestic prices and weaken productivity, both of which amplify inflationary pressure and strengthen the case for real assets. Central banks and the road ahead. As global growth slows, central banks are trapped between two bad options: keep rates high and risk debt crises, or lower rates and risk inflation. Either choice leads to declining faith in fiat. Gold, silver, and Bitcoin, despite their differences, now function as parallel hedges against this systemic weakness. Gold represents monetary history and trust. Silver acts as both a monetary and industrial metal, bridging old and new systems. Bitcoin represents a digital rebellion against centralized control. Their combined rise is a reflection of falling confidence in policy-driven money. The modern world has entered a slow but undeniable monetary transition. The debasement of money is not a single event, but a rejig, one that redistributes wealth, redefines investment, and reshapes the global order. For more than 5 decades, the world has been living inside an illusion. We've been told our houses got more valuable, our salaries got bigger, our economies grew stronger. People are just fed up. They are looking for assets that hold value. When trust in paper money weakens, the global monetary system is changing, gradually,